Have you ever imagined waking up each month to a consistent income, say maybe $1,800, and doing that without, having to actively trade stocks or manage some complicated business? For a lot of people, that sounds like, whoa, real financial freedom. So today we're doing a deep dive into one specific investment that gets talked about a lot for this kind of goal. It's the Schwab US Dividend Equity ETF. You probably know it as SCHD. Right, so our mission here is to really unpack how you could potentially generate that $1,800 a month from SCHD. We'll look at what it actually takes to get there, and importantly, how the strategy might fit into your own path to financial independence. What makes SCHD so, well, compelling right away is its focus. It's on U.S. companies, ones with really solid dividend histories. Plus, it has this remarkably low expense ratio, just 0.06%.
Which is incredibly low, yeah.
And it's shown strong long-term performance, with those regular quarterly payouts.
Yeah, and what's really insightful about SCHD's structure is how rigorous it is. It's very rules-based. It's not just like any old ETF picking dividend stocks. It meticulously screens companies within the Dow Jones U.S. Dividend 100 index.
Okay.
So it's not just chasing the absolute highest yields, because sometimes that can signal more risk.
Right, a yield trap.
Exactly. Instead, it prioritizes companies that are financially healthy, ones with a long track record of actually growing their dividends over time.
Yeah.
They look for strong fundamentals, things like high return on equity, low debt to capital. That helps, de-risk the dividend stream quite a bit. So this focus on, well, financially robust, established market leaders means it really aims for stability and consistent income. Often makes it less volatile than, say, a lot of growth-focused investments.
Okay, so this idea of $1,800 a month, it sounds fantastic, obviously. But for someone listening, what's the actual math? How do we get from SCHD's structure and its typical yield to that specific target number?
Yeah, that's the key question, isn't it? So first step, we need to look at SCHD's average dividend yield. Historically, it's kind of hovered around, let's say, 3.5% annually.
Okay, 3.5%.
Now, keep in mind, this yield can definitely fluctuate based on the market and the fund itself, but it gives us a pretty solid baseline for calculation.
Right.
So if your goal is $1,800 every single month, that works out to $21,600 per year.
Okay, simple enough. $1,800 times 12.
Exactly. So
Yep.
to figure out the approximate investment you'd need, you just divide that annual income goal by the dividend yield.
So the $21,600 divided by the 0.035.
Precisely. And that calculation brings us to roughly $617,143.
Wow.
Yeah, that's the estimated capital you'd likely need invested in SCHD
Right.
based on that 3.5% yield to generate that $1,800 monthly passive income.
Okay, so when you actually, run the numbers, yeah, $617,000, that's a pretty substantial amount of money. For a lot of folks, that might immediately sound like a really steep mountain to climb. But, and this is where it gets really interesting, I think. This is where the real power of the strategy comes in. Reinvesting those dividends. So how does setting up a DIRP, a dividend reinvestment plan, actually help someone bridge that gap? Especially if they're starting out with, a more modest amount.
Right. And this is where time and consistency become, well, your absolute best friends in investing. It's crucial. By choosing to reinvest your dividends, every single payment that SCHD makes automatically goes back into buying more shares of SCHD for you.
Oh.
So your holdings aren't just static, they're compounding. They're growing on their own and then generating even more dividends over time because you own more shares. It's kind of like that classic snowball rolling downhill, right? It just keeps picking up more snow, getting bigger and faster. And to put some actual numbers on it, let's look at a few scenarios. We'll assume, just for illustration, an 8% average annual total return. Now, that includes share price appreciation and those reinvested dividends. It lines up pretty closely with historical market averages for, diversified stocks over the long haul.
Okay, but not a guarantee, obviously.
Well, not a guarantee, just an illustration. But it helps visualize the compounding effect. So let's say you start with $10,000, and you consistently add an extra $500 every month. With that 8% illustrative return, you could potentially reach that $617,000 target in about 27 years.
27 years, okay.
Now let's change it up. What if you can start with a bit more, say $50,000, and you contribute $1,000 monthly? That timeline shrinks pretty significantly. Now you're looking at around 17 years.
Wow, okay, big difference.
Yeah. And one more, if you can manage to kick things off with $100,000 and put in $1,500 each month, well, then you're potentially looking at roughly 11 years to hit that same target.
Okay, 11
So
years.
these examples really powerfully illustrate how consistent contributions, when they're paired with the magic of compounding, can make what seems like a really daunting goal actually achievable over time.
I think about someone like my cousin. He's just starting his whole investing journey, looking at these huge numbers, maybe feeling a bit intimidated. For someone like him, how important is that initial mindset? The patience and just sticking with it, given these longer timelines we're talking about,
Yeah.
especially compared to like the instant gratification people sometimes chase in the market.
Oh, that's such a crucial point. It really
Yeah.
is. And it goes beyond just the numbers. It's the mental game. So many investors, they get discouraged early on if they don't see these like immediate dramatic returns.
Yeah, happens all the time.
But with a strategy focused on something like SCHD and reinvesting dividends, patience is just at paramount. It's absolutely key. It's a long-term play. Think marathon, not a sprint. The real growth, it often feels kind of slow at first, almost invisible sometimes. But then it really starts to accelerate as compounding kicks into high gear, usually in those later years.
Right, that J curve effect.
Exactly.
Yeah.
Understanding that right from the start helps you stay consistent, helps you stick with the plan, even when the market inevitably throws some curveballs your way.
Okay, so we've crunched the numbers, we've seen the power of compounding and patience, but just looking beyond the raw math, what really sets SCHD apart? Why is it considered such a, well, cornerstone passive income asset for so many people? What are those key advantages?
That's a great question. And it really boils down to a few core strengths, especially for income-focused investors. First, you've got those reliable quarterly payouts. They're backed by these financially sound, established companies, which gives you a certain degree of predictability.
Predictability is good.
Definitely. Second, that tiny 0.06% expense ratio, we mentioned it before, but it's incredibly significant over the long term. Think about it compared to actively managed funds that might easily charge 1% or even more every year.
Yeah, that adds up fast.
It adds up massively. That low fee means more of your money stays invested, working for you, compounding over decades, like getting free money back almost. Third, its strategic focus on quality tends to mean it's less volatile than, say, a lot of high-flying growth stocks, so potentially more stability for your capital.
Okay.
And maybe the best part for passive income seekers. It's remarkably hands-off. You buy it, maybe set up that DRP, and you don't need to constantly research and manage individual stocks yourself.
Okay, that all sounds incredibly appealing. Almost too good to be true, maybe. But often, when something sounds this good, there's a but, right? What are some of the common misconceptions or maybe potential pitfalls someone might overlook if they're relying heavily on SCHD for passive income?
That's an essential question to ask because, yeah, no investment is perfect or without its own set of nuances. So while SCHD definitely aims for consistency, it's really vital to remember that those dividend yields, they're not static. They're not guaranteed.
Ah,
They can and do fluctuate
Right.
based on broader market conditions, the fund's own performance, even just the share price moving up or down.
Yep.
Like if the fund's share price goes way up, the yield on any new money you invest might actually be lower, even if the dollar amount of the dividend per share hasn't changed.
Right, yield is relative to price.
Exactly. Also, don't forget taxes. Any dividend income you receive is likely going to be taxed. The exact amount depends heavily on, your country, your specific tax bracket.
Yeah.
And that definitely impacts your actual net income. And another big one, while SCHD is known for stability, it's still an ETF that holds stocks.
Right, it's not cash.
Not at all. So its price can go down, and it will go down in a market downturn, just like other stock investments. The dividends might hopefully remain pretty consistent, but your total invested capital, the value of your holdings, can still decrease significantly, at least on paper, in the short term.
Okay.
And that's where your investment horizon, how long you plan to stay invested, really matters. If you suddenly need that capital quickly during a downturn,
You might have to sell low.
you might be forced to sell at a loss, even if that dividend stream itself is still chugging along just fine. So it's a key distinction to make between income generation and capital preservation or growth.
Okay, so bringing this all together for you listening, building that monthly passive income, say $1,800 with SCHD, it looks absolutely achievable. But it's definitely a journey. It requires either, well, that significant upfront investment we
I think
calculated,
around 617K, yeah.
or maybe more realistically for many, a real long-term commitment. Consistent investing month after month, year after year, and letting that powerful force of dividend reinvestment do its magic over time.
Right. And whether you're, just starting out on your investment journey, maybe like your cousin, Or you're already a more seasoned investor looking to optimize your portfolio, SCHD really can serve as a solid cornerstone in a robust dividend income strategy. It's all about building a structured strategic plan for your financial future and using well-designed tools like SCHD to help get you there.
So, as you reflect on this deep dive we've had today, really consider what this information means for your own financial goals. Think about that $1,800 a month, not just as a number, but what kind of freedom could that represent for you? And remember that really powerful, actionable advice we pulled from the source material. Start now, stay consistent, and watch your passive income grow one dividend payment at a time. Maybe ask yourself, what's one small step you can take today or this week to start building that future for yourself?